Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. Today's discussion is all about capitalization rates, or cap rates, and pro forma statements in the world of real estate. These concepts may seem complex, but they are critical to understanding and navigating the real estate market. Whether you're a seasoned investor or just dipping your toes in, getting a handle on these terms can truly elevate your real estate game. Stay tuned as we unravel these complex terms in the simplest way possible. Cap rates, or capitalization rates, are fundamental to understanding the value and potential return of a real estate investment. Let's start with a simple definition. The capitalization rate, or cap rate, is a ratio that real estate investors use to calculate the value of income-producing properties. It's a measure that helps investors understand the relationship between an investment's net operating income and its current market value. Think of it as a snapshot of an investment's performance at a specific point in time, offering a quick way to compare different investment opportunities. It's like the miles per gallon (MPG) metric for your car. It gives you a baseline to compare efficiency. Now, how do you calculate cap rates? It's simpler than you might think. To determine the cap rate, you divide the net operating income (NOI) of the property by its current market value. The NOI is the total income generated by a property minus the operating expenses. The current market value is how much the property would sell for in today's market. For example, if a building has a NOI of $50,000 and its current market value is $1 million, the cap rate is 5%. Now, why do investors use cap rates? Well, cap rates allow investors to evaluate the potential return on an investment and compare it to other opportunities. A higher cap rate usually means more risk, but also more potential return. Conversely, a lower cap rate suggests less risk, but also less potential return. So, when you're evaluating an investment, you need to consider the cap rate in the context of your own risk tolerance and investment goals. Are you willing to take on more risk for a higher potential return? Or would you prefer a safer but potentially less lucrative investment? In the complex world of real estate investing, cap rates are a powerful tool that can help you make informed decisions. They won't tell you everything, but they provide a valuable starting point for assessing an investment's potential. Remember, a higher cap rate typically indicates more risk, but also greater potential return. Now let's switch gears to pro forma statements, another critical tool in the real estate investor's arsenal. A pro forma statement, in its simplest form, is a financial statement that projects the future income and expenses tied to a property. It's like a crystal ball, allowing investors to peek into the potential financial future of their investments. But remember, it's based on assumptions and estimates. So it's not a guarantee of what will happen, but rather a guide to what might happen under certain conditions. Let's break down the key components of a pro forma statement. First up, we have the projected revenue. This is an estimate of the income the property is expected to generate. It could come from various sources, such as rental income, parking fees, or other income-generating amenities. Next, we have the estimated operating expenses. These include costs for property management, maintenance, insurance, taxes, and utilities. It's important to note that these expenses do not include mortgage payments or depreciation, as these are not considered operating expenses. The difference between the projected revenue and the estimated operating expenses gives us the net operating income, or NOI. This is a crucial figure as it represents the potential profitability of the property. But we're not done yet. The pro forma statement also includes potential financial outcomes. This is where we consider factors like financing costs, tax implications, and potential cash flow. Now, you might be wondering, why is a pro forma statement so important? Well, it helps investors make informed decisions about property investments. It gives a snapshot of the potential profitability and financial implications of a property, helping investors to anticipate future cash flows, evaluate the feasibility of their investment, and compare different investment opportunities. Moreover, a pro forma statement can also be used to communicate the potential financial outcomes to stakeholders, such as lenders or partners. This can be particularly useful when seeking financing for a real estate investment. In conclusion, a pro forma statement is more than just a sheet of numbers. It's a strategic tool that can help investors navigate the often turbulent waters of real estate investment. By providing a detailed projection of future income and expenses, it allows investors to make educated guesses about the potential profitability of a property and adjust their investment strategies accordingly. A well-prepared pro forma statement can be the key to anticipating the financial impact of a potential real estate investment. Understanding both cap rates and pro forma statements separately is important, but knowing how they interact can truly elevate your real estate game. Now, let's talk about the interplay between cap rates and pro forma statements. These two are like the yin and yang of real estate investment. Independently, they provide valuable insights, but together, they offer a holistic view of a property's potential. Consider cap rates as a snapshot of the current market conditions. It's a ratio that shows how much income a property is expected to generate in relation to its price. On the other hand, a pro forma statement is like a crystal ball. It gives a forward-looking view of a property's financial performance based on certain assumptions. Here's how they work hand in hand. When you're evaluating a potential investment, a pro forma statement can be used to calculate the expected cap rate for a property. This is done by dividing the property's projected net operating income by its purchase price. The beauty of this is that the pro forma statement allows you to adjust the variables. You can tweak the income and expense assumptions to see how they impact the cap rate. This flexibility gives you a sense of control and allows you to better anticipate possible outcomes. But remember, while the pro forma statement paints a picture of what could be, the cap rate grounds it in reality. It's a balancing act between the optimism of the pro forma statement and the pragmatism of the cap rate. Moreover, by comparing the calculated cap rate with the prevailing market cap rates, you can gauge if the property is overpriced, underpriced, or just right. This is a vital step in the due diligence process, helping you avoid costly mistakes. In summary, using cap rates and pro forma statements together provides a fuller picture of a property's potential. It marries the theoretical with the practical, the future with the present, the what if with the what is. By using these tools in tandem, you can gain a comprehensive view of the potential risks and rewards of a property investment. As we wrap up, it's clear that cap rates and pro forma statements are vital tools in the toolbox of any serious real estate investor. The journey we've taken today has led us through the intricate world of real estate investing, focusing on two key elements: capitalization rates and pro forma statements. We started with the capitalization rate, or the cap rate, which we now know is a tool used to calculate the potential return on a real estate investment. By dividing the net operating income by the property's market value, we get a percentage that can guide us in decision making. We then moved on to pro forma statements, those hypothetical financial statements that provide a glimpse into the future of a property's financial performance. These documents are essential for both investors and lenders because they give a forecast of revenues, operating expenses, and potential profits. As we dove deeper, we discovered that these two elements are not standalone entities, but rather work in tandem to paint a complete picture of a potential real estate investment. The cap rate gives us a snapshot of the potential return, while the pro-forma statements provide a forecast of the property's financial performance. The interplay between these two elements is where the magic really happens. When we understand how they interact, we can make informed decisions about our investments. We can use the cap rate to assess the risk and potential return of a property, and then use the pro forma statements to forecast its financial performance. Together, they provide a comprehensive toolset for real estate investment analysis. In essence, understanding cap rates and pro forma statements is like having a roadmap and compass for your real estate investment journey. They guide you, help you make informed decisions, and ultimately lead you towards your wealth creation goals. And that's a wrap. Remember, the road to real estate success is paved with knowledge. So, keep learning, keep investing. This is Doc, signing off from the Wealth Boardroom. Don't forget to subscribe to the channel for more insights into the world of wealth creation.